All right, in this lesson, we're going to be talking about the initial cost of a long-lived asset, what goes into that initial valuation of a long-lived asset. We're going to first talk about a key word that you should understand when we talk about the acquisition of a long-lived asset. And then we're going to show you some examples of what would go into the cost of a long-lived asset. So let's get started here by understanding the word capitalization. So capitalization is a key word that we often use in the long-lived asset acquisition. So the question really is what is capitalization? So capitalization occurs when we record a cost as an asset rather than an expense, which is what we're going to be doing with all of our long-lived assets. So instead of expensing them, so we buy a piece of equipment and expensing it, we're going to capitalize it, which means we're going to take the cost of that asset, and instead of putting it in the expense column, we're going to put it in the asset column first, and then over time we will expense it. So capitalization means that instead of expensing it, we're just going to move it to the asset column, and then we'll expense it in a timely manner based on rules that we're going to teach you in this section. So when we buy a long-lived asset, we capitalize the cost. So the $25,000 car that we talked about in the last lesson, we're going to take that $25,000, capitalize the cost, so we're going to turn it into an asset, and then we're going to allocate the cost over its useful life. Then we're going to expense it. So when I say we're going to capitalize the cost, that simply just means that instead of expensing it, let's go ahead and capitalize it first, and then we're going to follow some rules when it comes to expensing it on our income statement. Now, what costs do we capitalize? Well, we're going to capitalize all reasonable and necessary costs to acquire the asset and prepare it for its intended use. So this goes a little bit more beyond than the cost of just acquiring the asset. So this includes any necessary and reasonable costs associated with that asset in order to get it to its intended use. So if you really think about it, kind of an everyday example, if you went to the store and you bought, let's say, a computer, that computer might be on sale for $699, but then you're going to have to pay sales tax. Well, that sales tax gets added to the cost of that asset, right? So once we have that, we might have to pay someone, a specialist, to install certain softwares on it for us to use. Well, if we do that, the cost of that installation would go into the cost of the asset. So that asset is no longer the $699 plus the sales tax, it's $699 plus the sales tax plus the installation cost, okay? Now, if we need to ship it somewhere, let's say we need to ship it to us because we bought it online instead of going to the store, that shipping cost would be added to the cost of the asset. So notice here, it says all necessary and reasonable costs to acquire the asset and prepare it for its intended use. So we're going to include a lot more than just the price of the asset. So for long-lived assets, it's just more than that purchase price. So the next question is, what does reasonable and necessary mean? Well, reasonable and necessary are costs would mean that costs associated with the acquisition should be reasonable, cost-wise, and appropriate to capitalize. So we want to make sure that when we're looking at what costs we're going to capitalize, that it's appropriate to what it should be. We're not overspending per se, and then it's appropriate to capitalize. We should capitalize because it's very much part of that asset. And necessary is that it will provide benefit to the organization. So we're not saying that the asset has to be absolutely necessary for the organization, but it does need to benefit the organization in a long-term perspective. So the cost that we're capitalizing should be reasonable and necessary. And why is this important? Because a lot of times companies want to make sure that their bottom line looks really good, their net income. And so you might see companies shifting costs from the expense line and trying to capitalize it so that their net income goes up. So if you were to take $1 million of expenses, capitalize that instead of expense it, now your bottom line looks $1 million better in that current year. And so companies have done that, and it's not legal, especially if you're doing it and you're not following GAAP rules. Now, if you buy a piece of equipment, yes, you can capitalize it, but if you have salaries expense and it shouldn't be capitalized, but you capitalize it anyways, now you're making your bottom line better when you shouldn't be doing that. And companies have gotten in trouble because of that, and they know what they're doing. They're trying to bring their bottom line up, and so they capitalize the cost because then it doesn't have to go reflected on the income statement. So making sure that our costs are reasonable and necessary. So what are some examples of these costs? Let's look at a couple of different types of assets that we might acquire that we would consider long-lived assets, and some of the costs that would go into those into those assets. So let's first take a look at land. So land obviously would start with maybe purchase costs, right? So what's the cost of that land? We would also maybe include title search. So obviously we're going to need to pay for title insurance and title searches. And so that cost, which is not part of the purchase price, would be added to the land's value or cost. Clearing of the building, clearing of any buildings to build on it. So if we were going to tear down all of the buildings on this land, whatever it costs to clear the land, we would include that into the cost of the land as well. Survey fees, maybe we need it surveyed for a potential building that's going to go up. That cost might go in there. And we might include legal fees. So again, all of these costs are associated with the land, and so we're going to add these costs to land. Now, buildings. So for buildings, some examples might be the purchase cost, any appraisal fees that we're going to have to pay to get it appraised so that we can be able to take out a loan for that building, legal fees associated with the building, architect fees. So if we're going to build a new building or make modifications, we might pay an architect, and that architect is going to do things that are associated with the building, and so that cost is going to be capitalized to the building. And then building inspection might be an example of another cost that is associated with the building. Now, for equipment, example might be the purchase cost. Transportation costs. So if we are having that equipment transported to us, whatever that shipping or transportation cost would be added to the equipment. Installation cost, the cost to install that equipment in our building or in our offices, that would get included into the cost of equipment. Testing cost, the cost to test out the equipment and making sure that it's working properly. Especially if it's very sophisticated equipment, we might need it tested. We can't just install it like we would do a printer that we would buy for our home office. So that would be added to the cost of equipment. And then sales tax obviously would be added to the cost of equipment because that has a direct correlation with the actual equipment purchase. Okay, so these are all examples of costs that would go into or capitalize to these assets. Now remember, we capitalize all costs associated with the acquisition of any long-lived assets, including purchase price and any cost to get it to the point where it's ready for its intended use. So the way that I like to think about it is, what's the cost to purchase it, transport it to where it needs to be, get it all set up so that it's ready for its intended use. If it's not ready for its intended use, then it still is not ready, and therefore we still need to, any costs that are still associated to getting it ready would be capitalized to that long-lived asset. So we're going to include everything to get that asset ready for its intended use. Now, one thing to understand when we talk about long-lived assets is materiality and those long-lived assets that we might acquire. It's also important to understand that many companies have a threshold in which long-lived assets may be expensed instead of capitalized. And the reason being is, for example, let's say a $2.50 stapler that you buy, it would last you longer than 1 year, but the question is it practical to take that stapler that's $2.50 and allocate the cost over, let's say, 10 years? That means every year we're going to have to make an entry for 25 cents for that stapler because it lasts for 10 years and it costs us $2.50. And that probably, the benefit of doing that would outweigh the cost of doing that entry, right? So it would cost us money to actually prepare that entry every single year. The person that does it, or the computer system that we have that does it, would cost us more than that 25 cents. So in some cases here, it's okay for us to expense it in the year that we acquired it, even though we should allocate the cost over its useful life. Now, there's usually a threshold. Companies will have a threshold of, let's say, $500. If the long-lived asset is underneath $500, just go straight to expense expense and don't even depreciate it or allocate the cost over its useful life. So that's important to know. So if you have any questions on that in your problems or your questions that you're trying to answer, if it doesn't have anything about materiality, then you're going to go ahead and allocate the cost. If it does, then you don't have to allocate the cost because it's going to be underneath that materiality. So only these small items probably most likely will not be questions or problems that you're going to have to do. But if you do, you have to understand whether or not you are going to allocate the cost or are you not based on the company's intent. So that is a talk about the initial cost of long-lived assets. Really what it comes down to is any cost associated with the asset to get the asset from where it's being produced to the point to where you are using it for its intended use. All those costs that are associated would be capitalized to the asset account in the name of the asset. And then we would allocate all of that cost over its useful life. So hope you enjoyed this lesson and we'll see you in the next video. Hey guys, if you like this video, make sure you press the like button below. And if you're looking for worksheets that go along with all of these lessons, head over to my website at patrickleemsa.com or click in the link in the far right. And I've got your next lesson right over here. So just click that link and it'll take you to that video. So until then, we'll see you in the next lesson.